Hey everyone, and welcome back to another video for today. So in today's video, I want to talk about 4 interesting companies and some pretty strong ones as well that have seen their stock fall more than the market, and analysts are seeing quite a lot of upside left over the next 12 months. As always, not here to waste your time. So here are the 4 stocks we're going to cover in this video. Of course, I sure hope you keep watching, and if not, at least leave me a like and a comment. And if you're new here, subscribe. And if you want to support me even further, do check out the link down in the description and the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so first up we have here Adobe, and of course we're going to use FinChat, the stock research platform that I show you in each and every video. So Adobe reported earnings a couple of days ago. Pretty good quarter, beats across the board, and yes, the stock was down 5.3%. On Friday, we're back under $400, which means that year to date, we are now down 11.3%. Over the last 3 years, the stock is only up 5.3% or so. It has a market cap of $167 billion, trading PE 25.1 times, forward one 17.9 times, and an average analyst price target of $491, meaning $100 more than the price we're at right now. Now, this is a company, of course, is not growing 20% or so year after year, but still expected to grow revenue for 2 years around 9.4%, with EPS growing around 11.3%. Now, as I said, they just reported earnings, and so if we go and use FinChat's transcript mode and then AI summary, we don't have to go and read the whole summary or listen to all of it for the earnings call. We just get here the highlight numbers. So last quarter, as per usual, as per the last couple of quarters, record revenue up 11% year over year, GAAP EPS of $3.94, digital media revenue of $4.35 billion, and that was up 12% year over year, digital media ARR of just over $18 billion, and that's up 12.1% year over year. And I'll show you why this is important, because you'll see that it's going up and to the right. Cash flow from operations, $2.19 billion. Now, of course, with Adobe, a lot of the focus is on whether or not they can monetize their AI tools, right? Monetization of AI credits. Well, they told us a couple of things here. One, Adobe is successfully monetizing AI through products like Acrobat AI Assistant, Firefly app and services, and Gen Studio. The AI book of business is tracking ahead of the $250 million ending ARR target for fiscal 25. So, there are 2 camps here. One camp saying that, look, this is way too early to tell us what that book is, right? It's $250 million, a big deal, right? You should have maybe started to report that when that number would be much, much bigger. In the meantime, tell us another story on how you're monetizing your AI application, maybe how you're attracting new customers or retaining the ones that you have right now, because they are now using multiple, let's say, AI apps inside the Adobe Creative Cloud ecosystem. They did tell us that the Firefly app is attracting new users, with paid subscriptions nearly doubling quarter over quarter and time subscribers growing 30% quarter over quarter. Total generations across Firefly and Creative Cloud apps exceeded 24 billion. They saw Gen Studio for performance marketing experience strong growth, with ARR growing 4x year over year. The platform is revolutionizing the content supply chain for enterprises. Now, as I said, we can go and look at some company-specific metrics here on FinChat for Adobe. So if we go and scroll all the way down to the key performance indicators, and we look at the digital media ARR, we can see the following thing. Yes, it's true that previously growth was, higher than what it is today. But even today, this thing is still growing quite nicely. If we go and look at the last, let's call it 5 years or so. 5 years, this has grown at a compound annual growth rate of 13.4%. Not bad, right? For a company that has been labeled as a dying company. I don't see dying anytime soon. We can also look at what the market is expecting Adobe to report when it comes to free cash flow for the upcoming fiscal year. So, free cash flow for fiscal 25 is expected to grow 17.4%, followed by 11.6% year-over-year growth in fiscal 26, and then another 10.5% year-over-year growth in fiscal 27, so expected to grow faster than revenue. And of course, you can check even more metrics and estimates on FinChat. Link will be down in the description and in the pinned comment. 15% off if you use my link. New users will get FinChat Pro for free for the next 2 weeks. Now, looking at the forward PE and trailing PE for Adobe. The trailing is the blue line, which of course is much lower than the average, but then again, a company like Adobe should not be trading at 50 times earnings, right? We're now at 25 times, which I think is quite okay. Looking at forward one, we're sitting here close to 18 times where the average was 31. Of course, previously this company was growing faster. Plus we've got that, of course, huge bubble 2021, 2020. So you have to take that into consideration. But let's say the forward one could go back to around 20 times. That should bump up the stock price. Looking at the stock price and comparing it to revenue and free cash flow. As you can see, usually, the stock goes up when free cash flow and revenue went up as well. And then we've had, of course, that big correction. I believe the stock was down over 60% in that bear market in 2020. Free cash flow did also come down a little bit. They had that $1 billion hit from the Figma acquisition. And then, the stock went back up. So revenue and free cash flow went up as well. And now we have that correction, despite the business continue to grow. So maybe there is a disconnect here. Because as you can see, Adobe's free cash flow and gross profit margin, gross profit margin have been improving over the last couple of years. Free cash flow margins have been improving as well, especially in the last 2 years. But again, that impact from the Figma acquisition, we're now back to 41.8%. So yeah, it does seem like the company is doing quite okay. Share buybacks. This company is also buying back quite a lot of shares. Over the last 10 years, total share outstanding went down by 14%. That's a compound annual growth rate of 1.6%. Now, I'd say time and time again, with Adobe, of course, you're not buying here a high growth company. No, you're buying here a solid compounder that will likely beat the market over the next couple of years, unless, of course, they completely fail to, monetize AI products, completely fail to retain their customers. So far, no indications of that happening. Moving on to company number 2, and that's Salesforce. Salesforce, as you can see, is underperforming the market this year, and then some. It's down 22% or so. Over the last 3 years, the stock is up around 55%, and over the past 5 years, it's up a little bit less than that. It has a market cap of $247 billion, trailing P of 40 times, but a forward one of just 22.2 times. This is a company that was growing 11.4% each and every year when it comes to revenue, and now is expected to grow revenue only by 8 to 9% or so, but EPS is expected to grow faster than that at 11.3%. Now, more recently, of course, we've had a lot of conferences, tech conferences, fintech conferences, you name it, and they told us a couple of things. Data Cloud is surpassing $1 billion in ARR. There are 8,000 deals that closed to date for Agentforce, but Agentforce is only expected to become more material in fiscal year 2027. The company is, of course, going to acquire another company. So yeah, another acquisition for Salesforce, around $8 billion. They've been acquiring a lot of companies over the past 10 years or so, whether it's Tableau, MuleSoft, Slack, and now Informatica. So we'll see how that works out. Of course, they think it should help the business grow even further and become stronger in this age of AI. If we look at what the market is expecting this company to report when it comes to free cash flow, you can see that free cash flow is expected to grow a bit faster than revenue here as well. In fiscal 26, it's only expected to grow 7.5%, but then we see an acceleration. It's expected to grow above 12% in each of the upcoming 2 fiscal years. Looking at margins for Salesforce, there was a time where free cash flow margin was declining, but in the last 2 years or so, free cash flow margin has been improving, and that's, of course, a very, very good sign. Same here for gross profit margin. This means they can pay a dividend, they can buy back more shares, or they can acquire even more companies. The company generates the majority of its revenue through subscriptions and support, and then the other is professional services. And as you can see, total revenue growth rates have been coming down quite a lot over the last couple of years, but at least the company is becoming more and more profitable. So at least you've got that, right? But of course, when you buy Salesforce, you do expect the company to see some growth or reacceleration in growth when it comes to revenue, which is what they are expecting. Gross profit, same story here. The majority, if not all of it, does come from subscription and support. Now, what we did see last quarter is we have, again, an acceleration in growth for RPO, remaining performance obligation, that did grow 13% last quarter. That's more than the 11.4% the quarter before that, and the 9.9% the quarter before that. So could be a very, very good sign for what's to come. Now, with Salesforce, I'll be very honest here. Of course, Salesforce a couple of years ago, it was all about SaaS, right? Software as a service, and it's not just Salesforce. It's every other company out there as well. But since ChatGPT came out, since we've had, well, this huge focus on AI, data centers, ChatGPT, NVIDIA, you name it, every software company, right? Every company that was a SaaS company suddenly rebranded to an AI first company, right? Suddenly there is no SaaS anymore. It's only AI, which is quite interesting. It's not just for Salesforce. Like I said, it's every other company as well. So yeah, when you hear, oh, AI revenue, just remember that probably the majority of it is still considered software as a service. Moving on to a non-American company called Adyen, a Dutch company. You can buy it in euros. You can also buy it in dollars, although that's over the counter, so OTC markets. This is a very, very strong fintech player. This is a company worth 52 billion euros. It is a stock that has never been really cheap, unless you bought it when it crashed, right? When it went down 50% or so, because in the short term, they were going to invest more in the business. And so their margins were going to come down, and suddenly the stock went down. Again, the stock was also very expensive. So it was a re-rating plus short-term issues, let's say. But the short-term issues, as you can clearly see, did not last that long. So over the last 12 months or so, the stock is up around 40%. Year to date, the stock is up around 16%. PE trailing 56 times, forward one 46.6 times. So definitely you are paying a premium for this type of company. But as you can see, revenue over the last 3 years compounded has grown 26.2%. If you look at the next forward 2 years, it's expected to grow 23.6%. EPS is also expected to grow 23.3%. So here you're getting a company with super high margins and a company that is growing top and bottom lines above 20% consistently. And yes, I think it's worth paying the price. Now, I'm not owning this because I do have already enough exposure in fintech, but I do know, and I've covered this company quite a lot of times, especially when it went down quite a lot. I did trade it for the short term. Yes, I know another, I'd say, successful trade. Could have held it because it is a quality company, but in my head, it was just a quick trade because the market was overreacting. But I do know that a lot of my viewers do hold Adyen because they like the company, they like the exposure to fintech, and they think that this is probably the best player out there in the public markets because Stripe is still private. And to be honest, I agree. It's one of the best players out there. It's not as undervalued as a PayPal, for example, but it is a very, very high quality business. And just to show you how expensive it was before, forward PE on average over the last 5-6 years or so was 78.8 times. Trailing PE was above 115 times. So yes, we are of course much cheaper today, but we are still expensive, but much cheaper than the average. If we look at what the company is expected to report with regards to free cash flow, actually in fiscal 25, free cash flow is expected to come down 25.8%, but then you see an acceleration by 30.4% and 26.9% year-over-year growth in 26 and 27 respectively. Now, like I said, this is a company that was growing extremely quickly before and is still growing above 20% revenue. Now you might say, whoa, what is this big drop right here? Well, this is just a change in reporting. So usually what we got here, this is settlement fee. But this settlement fee is so big, usually what you got is other revenue, which means that you have to deduct a lot from the settlement fee. Previously, they reported the gross amount and I believe even the cost. And now with the new reporting, you are well back to the actual numbers that they should have been reporting previously. So you've got that hit, but overall revenue is still the same, total revenue, because these increases right here, you would have deducted it each and every time by the difference, which brings us to the normal number that we're seeing right now. Moving on to TPV, or total processed volume, as you can see here as well, that is growing quite quickly in 2023 that grew by 26.4%. In the last 12 months, that grew by 32.6%. As for operating margin, that has bottomed out here in 2023, 41.9%. In 2024, that was 44.6%. Of course, we're not in the 50s anymore, but you never know. We might be making our way back up. Moving on to the last company, and that's Reddit, a company that a lot of you have asked me to cover, so here it is. Reddit is a company worth $21.8 billion, $118 per share. Since it went public, the company has done quite well, the stock has done quite well, up over 130%, but of course, it was up more than that. Now, since the peak, the stock is down 43.8%. Trailing PE 177 times, forward one 81.4 times, but in my opinion, there's no need to look at PE just yet for a company like Reddit. The average analyst price target sits closer to $147. This is a company that has been growing quite quickly and is still expected to grow revenue above 30% for the upcoming 2 years. Now at the start of May, we've got their earnings report. So revenue did increase by 61% year over year. Advertising revenue was up 61% year over year. As you will see, advertising revenue is basically how they generate the majority, if not all, of their revenue. Daily active users increased 31% year over year to 108 million. Weekly active users reached 401 million, up 31% year over year. Adjusted EBITDA margin of 29%, GAAP net income of 7%, and operating cash flow margin of 33%. They did tell us a little bit more about their future plans. So Reddit's AI-powered search feature, Reddit Answers, has reached 1 million weekly users and is expanding globally, starting with Australia and the UK. Integration into Reddit's core search experience is underway. International ad revenue grew 83% year over year, the fastest growth rate in 3 years. Mid and lower funnel performance revenue accounted for about 60% of total ad revenue and was a major growth driver in the quarter. Management did acknowledge potential bumps from Google's algorithm changes, but remained confident in Reddit's long-term growth opportunity. The word Reddit was the 6th most searched word on Google over the past 90 days. As for guidance, they expect for Q2, they expect revenue to grow around $46 to $53 million and adjusted EBITDA to grow around 180 to 230% year over year. Now, as you can see, free cash flow is still expected to grow quite quickly over the next couple of years, above 30% from fiscal 26 and 2027. As I've told you, the majority of the revenue does come from advertising, and then we've got here other source revenue is quite small. Now, in the future, there were some reports that they might monetize some of the posts right behind paywalls. I think they also have a couple of deals with some LLMs, so information data that you see on Reddit might be licensed to one of the LLMs in order for them to access it. There are various ways how you can monetize a platform like Reddit, but essentially right now it is just another advertising social media player. As for margins, gross profit margins, of course, over the past couple of years, well above 80%, and last quarter we were actually at 90.5%. Free cash flow is where the story is at. Free cash flow has been improving time and time again, now at 32.3%, so that's very, very good news. Now, to me, with Reddit, of course, it can be a very interesting play, right? The stock is down quite a lot since its all-time highs, but then again, was a lot of momentum, lots of hype. So yes, there can be a lot of upside for Reddit, but for me personally, this is just another stock, social media and marketing stock. Since I already have Meta and Alphabet, I think I am covered when it comes to that. But of course, this is a much smaller company that is definitely growing quite quickly, so I do see the appeal. I just personally don't like Reddit as a platform, but there are some interesting, let's call it forums or threads or whatnot on Reddit. And so all in all, that's about it for me in this video. If you enjoy this type of videos, hit all the buttons. Do check out FinChat down in the description and in the pinned comment. You will get 15% off. And I'll see you all in the next one. Bye-bye.